Okay, so you want to own a shopping mall, a big building, hundreds of stores, every single one of them paying you every single month just to stand there. Thousands of people walk past your storefronts every day. It feels like the easiest math in real estate. More stores, more shoppers, more rent checks. Here's the first thing nobody tells you: you are not buying stores, you are buying a rent spread. For most of the last century, retail was simply the highest paying use anyone could put on a large piece of land. Not housing, not offices, not warehouses. Retail rent, stacked across hundreds of tenants at once, out-earned almost every other option available for that same acreage. Which means the entire business model of a mall was never really about shopping. It was about which use of the ground underneath it paid the most. For roughly 60 years, retail held that title. This video is about what happens the moment that title starts slipping away, and about the strange hidden machinery that made malls so profitable while it lasted. Let's start with what it actually costs to get in the door. Building a large regional mall from raw land, the parking structures, the climate control systems, the permitting, can run into the hundreds of millions of dollars before a single store opens. But buying an existing mall isn't one market. It's several completely different markets wearing the same sign out front. A top-tier mall near a wealthy suburb, the kind with a waiting list of brands trying to get in, can trade for well over $1 billion. A weaker mall 2 or 3 tiers down, older, with fading anchors and a declining neighborhood around it, can sell for a small fraction of what it originally cost to build, sometimes barely more than the value of the parking lot alone. So the first rule of this business is simple. You are not buying a building, you are buying a bet on a zip code, and the sale price already tells you which bet you're making. Here's another detail worth knowing before you go further. Most large malls today aren't owned the way you'd own a house. They sit inside something called a real estate investment trust, or REIT, a company legally required to pass almost all of its profits straight to shareholders every year, in exchange for skipping corporate income tax. That structure is a huge part of why large-scale mall ownership exists in its current form at all. It lets ordinary investors own a slice of a mall on the stock market without ever personally dealing with a leaking roof or a bankrupt anchor tenant. The biggest of these REITs own dozens, sometimes over 100 malls at once, spreading the risk of any single property failing across an enormous portfolio. That is a completely different game from the one facing a private buyer, who puts everything, their entire net worth, into one building in one town. Say you've settled on a mall, and the purchase price seems reasonable. Before you collect a single rent check, there's a layer of costs that catches almost every new owner off guard. First, the anchor leases you inherit, and you don't get to renegotiate most of them right away. Some were signed decades ago at rents that no longer make sense. Second, deferred maintenance. Roofs leak, HVAC systems cooling over 1 million square feet wear out, parking lots crack, escalators need constant service. If the previous owner was cutting corners to keep cash flow looking good on paper, you find out the first winter you own the place, usually in the form of a very large repair bill. Now let's talk about how the rent itself actually works, because this is where the business stops making intuitive sense. The biggest store in the building, the anchor, often pays the least rent per square foot of anyone in the mall, sometimes 10 times less. A department store might pay a fraction of what the small boutique next door pays for the exact same footprint. Why would any mall owner agree to that? Because the anchor isn't really renting space. It's selling foot traffic. Every smaller tenant in the building is quietly paying extra rent just to stand near the crowd the anchor pulls in through the door. On top of that base rent, there's a second layer called percentage rent. Once a store's yearly sales cross an agreed line, the mall takes a cut of everything sold above it. Real income that scales automatically with how well the mall performs, without the owner lifting a finger. Then there's a third layer almost nobody outside the industry has heard of: common area maintenance, or CAM. This is the tenants collectively paying to keep the building running. The cleaning, the lighting, the security, split between them based on how much space each one occupies. And then there's the strangest detail in the entire business. A tiny kiosk cart sitting in the busiest intersection of a mall can, per square foot, out-earn a full-size store standing along the wall. In this business, size and rent are not the same thing. Position is worth more than space. But underneath all of that sits a trapdoor almost no first-time owner sees coming. It's called a co-tenancy clause, and it's buried in nearly every mall lease. If a major anchor store closes, the smaller tenants around it are legally allowed to pay reduced rent, or in some cases, walk away from their lease entirely. You don't see this cost on the day you buy the mall. You see it the day your anchor leaves, and suddenly a dozen unrelated stores are contractually allowed to pay you less or nothing at all. One departure doesn't cost you one tenant. It can trigger a chain reaction through the entire building. Now, the other side of the ledger, running the physical building is enormous. Keeping over 1 million square feet climate controlled, lit, cleaned, and secured year round is one of the largest recurring costs a mall owner faces. Property tax alone on a large mall in a major metro area can be one of the single biggest line items of the year. Insurance has been climbing sharply across the entire commercial real estate industry. And here's the trap hiding inside the CAM structure specifically. Those shared costs do not shrink just because part of the mall sits empty. The hallway outside a vacant storefront still needs power. Security still has to patrol the whole building, not just the occupied sections. So when vacancy rises, that same fixed pool of expenses gets divided among fewer paying tenants, which means each remaining store's bill goes up, even though nothing about the building's actual upkeep has changed. This is why occupancy numbers lie. A mall can look 90% full and still be bleeding cash if half of that occupied space is anchors paying almost nothing. None of the mall's layout happened by accident either. Anchors are deliberately placed far apart from each other, so shoppers walking between them pass dozens of smaller storefronts along the way. Ends of corridors instead of the middle, forcing you to walk the full length of the building to find one. Even the lighting is engineered, mixing daylight with artificial light so you lose track of how much time has actually passed. One sentence explains the entire design logic of a mall. Force movement, and you increase exposure. Exposure is the actual product being sold to every smaller tenant in the building. For most of the 20th century, that formula worked because the mall's real product wasn't clothing, it was convenience. It was the only place in town where you could walk in and compare 5 different brands in a single afternoon. Online shopping broke that monopoly completely. Now you can compare 100 options from your couch and have it at your door in a day. The mall's entire reason for existing quietly stopped being unique to malls. And this is exactly where the co-tenancy trapdoor turned from a footnote into a crisis. Department store closures over the last 2 decades didn't cost mall owners one tenant at a time. They cost entire wings at once, floor plates sometimes over 100,000 square feet, built for one specific kind of tenant, and nearly impossible to subdivide cheaply. Some owners have spent 9 figures over several years just to carve a single empty department store into something else entirely. To understand how this plays out, picture one real mall's timeline. Opens in the 1970s with a strong anchor and a handful of stores around it. Grows over 2 decades into a genuine local landmark. 5 anchors over 100 tenants, close to full every weekend. A newer, shinier competitor opens across town. One anchor relocates. Another quietly closes after being rebranded twice in 2 years. Occupancy falls. The property changes hands for a fraction of what it once cost to build. Interior. Traffic thins out until the last remaining anchor finally shuts its doors, and the building sits mostly empty for years, slowly attracting the kind of attention no owner wants. Vandalism, theft, unpaid taxes, and eventually, demolition. Keep this in mind if you ever think a full mall means a safe mall. Buildings like this were nearly full at their peak. It can take less than 2 decades to go from that number to a pile of rubble and an empty lot. So the malls that survived changed what they were selling. Clinics, gyms, co-working space, apartments, anything a screen genuinely cannot deliver to your door. Retail's 60-year reign as the highest paying use of that land is ending, and the buildings still standing are the ones that found a new use willing to pay the rent. Retail used to. There's a tax angle worth understanding here too. Large mall owners depreciate these buildings on an accelerated schedule, sheltering a meaningful slice of taxable income every year, simply because the tax code treats a shopping center like any other aging piece of business equipment. It's not a loophole, it's the same depreciation logic used across commercial real estate. So does owning a mall actually work as a business? The honest answer depends entirely on which mall, and the gap between the good outcome and the bad outcome is enormous. In the good scenario, you own a well-located mall with strong anchors, a healthy mix of restaurants and services alongside traditional retail, and low vacancy. Base rent, percentage rent, and CAM reimbursements together produce steady, predictable income every month. And the property value climbs right alongside the neighborhood around it. This is the outcome that made the biggest mall-owning companies in the country into some of the largest real estate businesses on the stock market. In the realistic bad scenario, one major anchor leaves. Co-tenancy clauses fire across the building. A wave of smaller tenants renegotiate their rent down or simply don't renew when their lease expires. Utilities, insurance, and property taxes keep climbing regardless because those bills are tied to the size of the building, not how full it is. The empty anchor box sits there, generating zero income for a year, sometimes far longer, while still needing to be secured, insured, and maintained. The building itself doesn't change between those two outcomes. The economics underneath it does. A mall looks from the outside like a building full of stores. From the inside, it's actually a single, tightly interconnected financial system where every tenant's fortune is quietly tied to every other tenant's fortune, whether they realize it or not. The anchor never really sold appliances or clothing. It sold foot traffic, and the building itself was never really in the retail business. It was always just renting itself out to whoever could pay the most for the land underneath it. Retail simply happened to hold that title longer than anyone expected. Subscribe for more videos.